Hi, I'm the lead developer at Sigma1 Financial Software. I've developed a product I like to call Hal0 in homage to Hal 9000. It is a portfolio optimization software that, as far as I can tell, is unique in the industry. It optimizes on a variety of metrics rather than the standard two risk, however you decide to quantify it, such as standard deviation and expected return or historic return, which is usually easy to define but difficult to predict. What the software does for investment professionals is provide a framework to plug in their own return and risk models, and it supports the ability to plug in more than one risk model. It allows you to see you can plug in two risk models and a return model, and it can optimize within that space. It's basically, rather than creating an efficient frontier, if you will, that's simply a curve, it creates a surface in 3D. It can even support more input variables. Generally, you would have something like 3 risk models and a return model, but that's very difficult to visualize. I'm going to show you a quick demo of the capabilities of the software, both in terms of a quick assessment of how fast it runs, which I think is quite fast, and the other thing I'm going to show is how it plugs in straight away into visualization capability in that 3D space. Without further ado, let me launch the program. Right now, it is exploring thousands and thousands of portfolios on this Linux workstation. And once it reaches generation 52, actually, it'll pop up a unique display. There it is. What we see here in this display is actually a range of portfolios. This X denotes the initial seed portfolio. And what it's doing is trying various weights of the available securities. And what happens here is this purple axis is the expected return using a proprietary metric. The darker purpler colors are lower return, and the yellow colors are higher returns. The initial portfolio is here, and you see that this is one risk metric. This quadrant is considered the safest quadrant. It doesn't find any worthwhile portfolios in that quadrant. The initial population starts with a it's designed to be a perfect risk metric for sector diversification, but it's not perfect with respect to beta risk. That would be here. As the portfolio software explores, it finds and generates 100 portfolios that cover this surface. This green line represents a gradient of 8%, so anything crossing this line, this is less than 8%, this is greater than 8% expected annual return. Let me show you that this is a 3D graph. When I turn it like this, you can see that it's sort of like a spiral staircase for this particular set of portfolio investment options and weights that the financial engine comes up with. You can see the initial portfolio is right here in 3D, and you can see the portfolios that come along. Now, there's not necessarily a timeline saying that it progresses in this direction. That would be a different video and would take me a little longer to shoot. I'm just trying to get across the basic functionality. I'd also like to note that this ran extremely quickly. It ran in 17 seconds. Now, I can bump up this number here to do much more exploration, and this sim will take a bit longer. Here goes. And for this particular set of portfolio optimizations, it's going to produce a result that is extremely similar. In fact, if I think about it, I may actually do a shorter sim to show you how it converges in about 20 iterations. The cost metrics, by the way, are all non-linear, something that can give a classic covariance matrix based portfolio optimization techniques. Great deal of trouble. This presents the nonlinearity, presents no problem to this algorithm. Here we are, it's 80 generations in, here comes 90. By the way, I'm also growing the population of portfolios as I increase the generations, so it's really redoubling its efforts. And again, it produces a almost identical graph. You can't tell graphically. You'd actually have to look at the reports to see minute numerical differences of on the order in terms of return of like 0.01%. So at 50 generations, this has really by then converged. That's pretty much it for this quick demo. I hope you found it useful.